there's a lot of commentary going on about, hold on. Hello.
Yeah, we're still here.
Hold on.
What was that?
There's this old rotary phone in the room that I'm recording in. This is an old, it's not even a rotary phone. It's an old touch. What do you call those? I know what a rotary is called,
Push
but I don't know what the other one. Push button, touch tone. I don't know.
It's not a. What would be a touch tone phone?
Well, you push the buttons and there's a tone to each button. All of that can be cut and we can go.
The advice provided on this podcast is general advice only. All statements made are considered by the participants to be accurate, but accuracy cannot be guaranteed. It has been prepared without taking into account your objectives, financial situation, or needs. All participants in this podcast may have a financial interest in any or all of the products or securities mentioned. Before acting on this advice, you should consider the appropriateness of the advice, having regard to your own objective, financial situations, and needs. If any private products are detailed on this website, you should obtain a product disclosure statement relating to the products and consider its contents before making any decisions. Where quoted, past performance is not indicative of future results.
Welcome to episode 26 of The Money Path with Bob Iacchino and Mike Arnold, founders of Path Trading Partners. I'm your host, Stafford. The What and the Why segment this week is sponsored by MotiveWade. Go to pathtradingpartners.com and download your 14-day free trial. So let's join Bob and Mike with a conversation on the markets that's already in progress.
Well, now we have the week later. Remember all the fear mongering and everything else? How the world was coming to an end.
Yeah.
Where were we trading that? Like in the S&P, we were trading like at 2112, and now we're trading at 2097.
I know. I mean, you and I talked about it in the podcast. We talked about it offline. I mentioned it on BNN. I said this is just it's overdone. There's no way to sell the market off right now, or to make sense of selling the market off right now off of the Brexit, because nobody knows what's going to happen.
Yeah, nobody knows what's going to happen. That's precisely right, and we're back to where, roughly where we're trading. So we're back to roughly where we're trading.
And I am sitting where I am.
Yeah, well. Exactly.
The S&P 500 closed where? It closed at the SPX, the cash, closed at 2113.32 day before the vote. And right now we are at 21. What are we at right now? 2105. So we're $6 below. So $6 is what they've got priced in right now. And by the way, we're up as we speak. We're up 0.3%. So we're actually still rallying, technically. We have done nothing but rally since the bottom was made. That's kind of a self-fulfilling statement, isn't it? Best theater of the Abbott. Since the bottom, we've gone up.
And we've rallied in a rather dramatic fashion.
That sounds like a Kenny Polcari statement. Since the bottom was made, we went higher.
I was just looking at, all right, so the S&P, NASDAQ, they're nearly back to where they started off before the Brexit sell-off. Bonds, like the 30-year U.S. Treasury bonds, higher, meaning even lower yields. So
lower yield.
Now you have the market rallying, you have bonds rallying, you have notes which are just off their highs. I'm looking at my charts now, slightly off their highs, but not much. They have not really had a substantial pullback, slight pullback, but not major. Just sort of interesting to note that so bonds are rallying, equities are rallying. What do you make of all that?
Well, it's all if you believe that the Brexit is an unknown as opposed to a negative, right? Which I think is the most positive spin you could put on it at this point. It is an unknown. It's an unknown. We don't know what it's going to mean. There's now been a lot of academic comment that has come out, as well as economic comment, as well as political comment, that this could actually be better financially for the UK specifically, and that the European Union may now act in a more democratic fashion because they've seen that someone actually will leave.
Somebody will put their foot down and say, no.
Yeah, and there's all these people. There's been a lot of commentary about how the Brexit, both academically, economically, politically, about how it could actually be a better thing for the UK, and the EU will act more responsibly and more democratically now because they've seen that a country actually will leave, and a significant country, not a Greece, right? A significant country, the UK, which arguably because of its ties to the US is probably the second most important country in the EU. So it's interesting to see how this plays out. Are they going to get some sort of special nation status like Switzerland has? Or, is the rumors of a contentious divorce, have they been overblown? But anyway, the market essentially rallied back. And one thing that happened that is almost a definite now is that the Fed was taken out of the picture in terms of continued rate hikes, which is what the market has rallied on in the past. And what it seems to me the market is rallying on again. And Mike, you just mentioned bond yields. I mean, bond yields are a lot lower. Interest rates are now lower. Companies have survived on the sort of stimulus of low interest rates, and that looks like it's going to continue. So why wouldn't it rally from there? Why wouldn't it happen?
Yeah, well, very good points. With the pound, I mean, a lot of markets have bounced back. The pound certainly hasn't.
Yeah, and it shouldn't, right? Because that's the direct effect. We talk about correlations a lot. We've talked about, I should say, correlations a lot. And one of the things Mike and I always say is, like, people try to trade correlated markets and they say, oh, the pound is down, so I'm going to sell the euro because they're correlated. Well, the pound is the actual only thing that should have been sold off because it was rallying on the idea that the Remain vote. Can I make this the last time we use these stupid terms?
No, yeah, the last show was the last time, but we broke it already.
Well, I know we broke it already. So the vote was supposed to win, and the pound was rallying off of that. And people who had invested in the pound, now the pound should be weaker because theoretically, if the UK is going to suffer economically, then the Bank of England has to cut rates, which means there'll be more pounds in circulation. And that's a supply and demand trade. So that one shouldn't recover.
Yeah, the markets are expecting a Bank of England rate cut.
Right.
The OIS forward curve fell to 0.25% for contracts maturing in October of this year, and 0.2% for them maturing in January 2017, which would suggest that a 0.25 percentage point cut in interest rates from the Bank of England is now expected in the following months. So.
Yeah, and for those of you that are listening that don't know, a rate cut hurts a currency, hurts the value of a currency because it's everything that we talk about is supply and demand, every single thing. And if there is more pounds in circulation, which is what a rate cut does, if there's lower interest rates, more people will borrow from the banks, and the banks borrow from the central bank. So that increases the amount of currency in circulation. So the central banks hold a certain amount of currency, and I mean, it's been said that we print it a lot now, but whatever. They hold a certain amount of currency, and when you borrow from a bank, the bank borrows from the central bank to replace those reserves. So the amount of currencies that are in circulation theoretically increases. So when there's more supply of something, the price goes down.
Yep, and they're not expecting any rate hike in England now until at least March 2021.
Wow. They're predicting that far out.
Yeah.
We don't know what the Brexit's going to be, but we know there's not going to be a rate hike.
Uh-huh. But S&P Global Ratings lowered the UK to AA from AAA with
They're always ahead of the curve, aren't they?
a negative outlook, and Fitch cut its rating from to AA from AA plus with also a negative outlook.
Well, if Fitch did it, it matters. We love Fitch here at the podcast.
So, let's see. Let's see what else is out. Now, also in the EU, the S&P Global Ratings lowered its long-term issuer credit rating on, to AA from AA plus, and the A-1 plus short-term rating was affirmed. So the outlook is stable. That I'll just sum it up. They say the outlook's stable.
Who said that? Is that all Fitch?
That's S&P Global Ratings on the EU. The outlook is stable. So Now, but you want to know what's not stable?
It's unstable.
Oh, we're going to your mother country, the Italian banks. All right. Let me go through some of this because you'll probably have some comments on this, but this is pretty good.
I said, don't make me go all Jesse Williams on you, but the Italian version.
Let's see. Italian banks concerns are focused on the banking sector's 200 billion. This is in the euros. 200 billion euros of gross non-performing loans, which they should be called gross non-performing loans. Which almost 85 billion euros have not yet been written down. The bad loans built up during Italy's 3-year recession and a decade of stagnation are weighing on the bank's already weak profitability and limiting their ability to lend. So essentially, Italy's banks are the Achilles heels of the Eurozone financial system. It's just bad. It's now impossible for Italian banks to raise capital. They're caught in a pincer as the ECB simultaneously demands compliance with tougher capital adequacy buffers. In some cases, demanding fresh infusions of capital 3 or 4 times. So the banks aren't doing very well in Italy.
I'm going to borrow from Jesse Williams' speech and say, if you're going to criticize the struggle, you better have, I don't know what I was going to say. But, yeah, the Italian banks are in horrible shape. And by the way, they own a decent amount of Portugal and Spain debt as well. If you remember, the term the pigs of the Eurozone is Portugal, Italy, Greece, and Spain. So Portugal and Spain's banks are not in much better shape. They are in better shape than Italy's banks, but they're not in much better shape. And there's a lot of sort of circuitously owned debt between the 3 countries. So it's ugly. It's not you hear people say all the time that you should invest in European stocks because they lag, they've been lagging the US and they're going to kind of fly back and make up some of the spread between the two. But I don't know, man, the banks are in really, really bad shape. The banks here are back to solid footing. All the banks passed the stress test in the U.S.
We'll get to that in a second.
Yeah, they all passed.
Yeah. So. Although Mr. Renzi, he said he may be forced to take matters into his own hands with the Italian banking system and defy the EU unless he wins concessions soon from Brussels. So we'll see how that's going to work. So, but the EU now has authorized Italy to use government guarantees to create precautionary liquidity support program for their banks. So it's just all we're just going to have to keep our eyes on Italy. That's a big one. So I don't know why Italy would ever leave because, we talked about that last week, but, they're talking about, well, maybe we should leave. Well, I don't know how that's going to work with the EU. But you just also mentioned the Fed had the bank stress test. Do you want to let people know what that was and know what that means?
Yeah, the bank stress test, it was something that came about with Dodd-Frank regulations, where the Fed was now to place banks under, I believe it's quarterly stress tests. And then what they essentially do is it's a set of it's like a questionnaire more than it is a test, right? Where the Fed puts about a bunch of potential crises in front of the bank and asks them to sort of classify their assets, and the Fed double checks it supposedly. And essentially it's a way of testing whether the banks would survive a crisis similar to the one that we had in 2008, 2009. And the stress test, I guess the easiest way to put it is evaluates the bank's resilience in disaster. That's how the Fed puts it. And again, it was the key element of Dodd-Frank. So they put a hypothetical crisis scenario in front of a banks and they evaluate their resilience, being able to stand it. So all the U.S. banks passed. I think that's the first time that they all passed.
Morgan Stanley did pass, but it was, I don't have that in front of me, but I did read that this week, but it was on conditions that they do they still have to do a few things.
Yeah, well, the 33 biggest U.S. banks passed. So I think if you had one bank go under, I think it wouldn't be crushing to an economy. And again, remember, this is a crisis scenario, theoretically. It's a hypothetical crisis scenario. But the 33 biggest U.S. banks, they were all considered to have passed. By the way, funny thing about what you just said, Mike, if they're saying, okay, you passed, but you got to do this, that kind of sounds like crisis bubble producing stuff, doesn't it?
Yep. Well, the banks that didn't pass, we had Deutsche Bank didn't pass, and Santander didn't pass. So Deutsche Bank hasn't been doing so well.
They haven't passed, like the last two.
Yeah, they have not been doing well. Their stock is just getting absolutely obliterated. Mm-hmm. We're now trading their stocks down to, well, right now it's trading 1404. Its low it put in this week was 1340, which is below where it was trading in at the end of 08 and in 09. So it's trading way worse than even that. But I was something sort of ironic, you know. Deutsche Bank released their interim report on March 31st, 2016, and it was titled Passion to Perform.
Well, that's not ironic if performance also doesn't mean doing well. You know, people can have passion to go down.
They've performed just rather negatively, so maybe they have a passion to perform pretty poorly.
See? It's not ironic.
But, hey, how about all these after the stress test came out? What did a lot of the U.S. banks go do, Bob? They initiated stock buyback programs and raised dividends. They took their money and, hey, we're going to buy back some more of our stock and we're going to raise our dividends.
You know, it's funny. This podcast is all about what we think, right? But our jobs are all about what's going to happen or like where the things are going to go. So, you know, we try to keep this keep it away from the political spectrum. But it's funny when the actual stocks are going up based off of political type actions like that. Right. I mean, the minute that they pass the stress test, they buy back and they raise dividends to try and pump up the stock.
Yep.
Which is how they get paid. You know, it's like I'm in a sort of a mindset of like, look, I can't blame you guys for doing that. Right. I mean, that's how you get paid. So I get it. But it's just it's the whole thing. Like Mike and I agree that all of this is going to end very badly. But I think we differ, and maybe we don't, Mike, because we haven't talked about this in a while, but we may differ on the time frame. Like, I think we can have 15 years of this crap. I really do.
I don't think we'll get away with 15 more years of it.
Yeah, just this financial engineering stuff. It's like, because at the end of the day, you know, what's the revolution going to be that changes it? Bernie Sanders? I don't know.
Well, there's going to be something that comes out of – there's going to be the black swan event that nobody saw that's just going to sort of break the camel's back at some point. Again, things can remain irrational longer than you and I think, and I agree with that. Do I know a timing when it can end? No. I think it's going to end sooner rather than later. What sooner? We could get away with this for, again, I think, but this financial engineering at some point is going to come back and bite everything in its butt. That's my.
Why did that make me laugh so?
I don't know.
It's gonna bite everything in its butt.
Yeah. Did you see the passion with that statement? Did you see it?
It just sounded like something one of my younger nieces would say. Gonna bite everything in a butt.
I didn't say in a butt.
I know. This is funny. I had a guy reach out to me on Twitter this week asking me, so I made a $55 call on crude oil, right? The crude oil was going to go to $55. And then I wanted to buy the dip. And we had two dips to buy, and there's been rallies after both dips. We're up a tiny bit today after falling yesterday. But both dips were about to the 46 level. They didn't quite get to 45, both dips in crude oil. But anyway, the guy reached out to me and asked if there was a time frame on my $55. And this brings me to two questions for you, Mike. Number one, can you explain better than I can why we don't care about the time frame? And then number two, how's your transports looking?
Oh, well, no, we don't care about time frame, and I'll tie this together. What we do care about is targets and stops. So, for me, if we get a close, my stop on a crude trade is if we get a close below, I have a couple levels below that 46 level, and really it's a close below the rising 200 MA. That would invalidate my or your $55 target for me. But besides that, if we don't get that, there's no time frame. I think sometimes people ask time frames because they want to know, okay, when's the trade going to be wrong? We don't look at it in terms of time frames because we cannot predict how fast or slow it's going to get there. All we know is we are in the trade until it either hits our target or hits our stop. And at some point we might have a trailing stop, but that really dictates the trade. It does not matter if it takes a week. It does not matter if it takes a month. I'll give you an example, tying this into your other question, which let me look up our transports. We talked about a double top, which was on a weekly basis. I don't remember how many weeks ago that triggered. Let me get to my chart.
Well, while you're looking at your chart, let me just throw something in on the crude oil so everybody understands. It's not a Mike Arnold pattern as to why I called for 55. It was based on some of Mike's scan analysis. Is that if we made a new high above 51.67, 54.90 was a likely place for it to reach. And when you get there, traders will reach up to that even number. It matters to them. It doesn't matter to us. So when I say things on TV, I actually said my target's actually 54.90, but let's call it $55. I actually said that on TV. So it's not a Mike Arnold target. We actually have gotten one close below that 50 moving average that happened 4 or 5 days ago, and the market immediately jumped right back up it. So it's not, there's no technical
right at
trade
the
there.
moving average.
I've got it right below.
Oh, your moving average is wrong.
Okay. I'm not even going to argue with you there, but I had on, it doesn't matter because there was still no trade signal there because the $55 target was not based off of a pattern that we trade. So I just wanted to make that very clear. But I had the moving average right around, the close was 46.61, and the moving average that day was right around 47.18 or so, 47.09, somewhere in that range.
And I'm watching for a close below what would invalidate this being a more bullish move. I'm watching really that rise sloping up 200 moving average now, which is, we have that support from the 50. We're sort of in this, if I was going to tie this into a Elliott wave projection off the low. Okay, we had essentially the low put in early February to our high in March, and which was wave 1, pull back into beginning of April was wave 2. We've now rallied up in a wave 3 to June, high of around the 8th, and we're pulling back into a complex wave 4. And once we get back again, that close above the 51.67 level, we'll be on our way to wave 5 for all those Elliott wave fanatics out there. Now, I'm going to jump back. And
just last thing, and then
sure.
I did ask you the question on the transports.
Keep interrupting me.
The guy's name was Randy Abnozio, and that asked me that question on Twitter. And his Twitter handle is at ANAUBURNTIGER, at an Auburn Tiger is what that actually is. But anyway, we still haven't violated the first cross weekly R zone on crude. So the crude oil trade could go down lower than 45, and I'll still stick to buying that.
Yep.
Sorry, Mikey, go ahead.
Now, back to the time frame. Back on the week of the May 9th, seems like forever now, we triggered a double top in the transports. Then we went sideways to slightly up for 1, 2, 3, 4 more weeks. Then fell back down on the week closing the 13th. And we finally hit the target this last week. Which we ran down. We had a target of 71.20. We the lows that were put in this last week on the Brexit sell-off were 7,029, so that easily hit the target. Now it's rallying back, but we hit the target. If that was a trade that was on, it would have been pulled off. It completed the target. Now we're rallying back. But how many weeks did that take total? Since it closed and triggered the pattern, it took 1, 2, 3, 4, 5, 6, 7 weeks. It didn't get there the next week. It took 7 weeks, and that whole time we've been updating it on the podcast, but we didn't care it took 7 weeks. It's a weekly pattern. It could have taken 13 weeks. It could have taken 2 weeks. We do not know.
Do you have that percentage move? Was it somewhere around 6% maybe?
I do not have that right in front of me.
That's okay. I have my handy-dandy little clicky calculator here.
I'm going to hear it clicking away.
So the trigger would have been 76.2388. That would have been the trig. That would have been where we needed to close below. I just want to get the move, not the trade. So what was the target, Mikey?
71.20.
71. Oops. Hang on. 76.2388 minus 71.20 equals divided by 76.23.88 is a move of 6.6%. So 6.6% in 7 weeks?
Yep.
About 1% a week. If I called you up and said I can make you 1% a week, who's hanging up the phone?
There's now only an 8% chance of a rate increase this year.
That's almost a good segue.
But yeah, but they're pricing
it's
a 10% probability. Give me a freaking bone.
Throw me a freaking bone.
There's still a 10% probability of a rate cut this year. So the odds of a rate cut are higher than a rate increase.
That's I call that the Kenny Polcari indicator.
Are you going to elaborate on that, or how is that the Kenny Polcari indicator?
Because the percentage is based on the Fed funds futures contract, and it essentially just adjusts with the market. It's accurate because it ends up being exactly what the Fed does. You know what I mean? But it's a rear view indicator.
Well, doesn't it become a self
it's a rear view indicator. It is.
It normalizes to what they're going to do.
Exactly. It's based off. People look at that and there goes 50% chance of a rate hike. No, there's not. Just the price of the futures normalizes to where the Fed funds rate is. So all you got to do is look at the Fed funds rate, and you're looking at the percentage. You know what I'm saying? But yeah, it's funny that now you'll have people saying and talking about it, and they'll say that, Fed looks like they're going to cut. No, not really. It's just kind of where the dot plots does a better job of it for us now, I would think.
Well, I still like the dot plots that are sitting, the two dots that are just not moving forever. And then they disappear. That was Bullard, wasn't it? Where it said,
and they're gone.
You can't look that far out, but for the next while, it's just going to sit here.
And they're gone.
And then they disappear. Hey, we got Q1 final GDP.
Mm-hmm.
It rocked. Came in 1.1%.
I'm still predicting a 3% print in Obama's last quarter.
Well, they're
no modern day president has ever had a term without a 3% GDP in it. Now, by the way, again, we keep things politically, so I don't want emails off of this. The president has very little to do with the economy. That's my opinion. Actually, I think I can back it up pretty sternly, but the president has no direct effect on the economy, virtually none. So when presidents take credit, it's funny. When presidents get blame, it's funny because they really have very little to do with it. By the way, I'd argue the Fed has very little to do with it either. They have a bigger piece or bigger part than a U.S. president does. But I cringe whenever I hear somebody say, I wish we could get Bill Clinton back because the economy was good under him. Okay. All right. Try that out. See how that works.
Boy, that just, what if you annualize?
That's one of the, but that's, yeah.
Could you annualize that?
No, I can't. I'm not even doing that. That's so funny. And that's what a lot of BS people do is they go, we made 6% on a trade in 2 months. If you annualize that, join our service.
Yeah, well, I like the people who do it like they do one trade and they have it on for a day and it produced like a 1% return. And then they're like, if you annualize that over Well, if you annualize that over a year, you wouldn't be making over 250%. So join our service. It's like, okay.
If you analyze the hours you spend listening to the Path Trading Partners podcast over the course of a year, you would find that
You'd make a lot of... You'd be infinitely rich.
Smarter.
No, we can annualize that. And so, speaking of annualized, there's now only an 8% chance of a rate increase this year.
That's almost a good segue.
If we do get that 3% print, I would not be shocked if then it was revised much lower.
I will be skeptical. I will be skeptical of that print.
Oh, let's see. Let's look at some mixed news, other economic news. So personal spending month over month came in at 0.4%, which was in line with expectations, but the previous was 1.1%. Personal income came in at 0.2% versus 0.3% expected, and the previous was 0.5%. So personal income is on sort of a downward trajectory, or not as increasing as fast, but the spending is still at 0.4%.
Right. It's a flattening uptrend.
Yeah, it's a flattening uptrend.
It is. And it's troublesome because what I worry about is we finally, this is not necessarily a good thing, but we've seen consumer credit rise, debt levels start to actually flatten out and now rise a little bit. And I hope they're not slowing their spending because they're concerned with debt again. Because that would be bad. That would be bad timing.
Let's check this out. Hey, Tuesday, JGBs. What are JGBs, Bob? JGB, Bob.
What's that?
What are JGBs?
Japanese government bonds.
You know what happened? They became the first sovereign debt in history to have yields of less than 0.1% across all maturities. Yeah. Even their 40-year bond is now just yielding, or it was earlier this week, 0.065, and the 10 years now negative 0.23%.
Yeah. Yeah.
So essentially, you're lending them money for 40 years and getting 0.065%. So it's essentially you're not
getting all
anything.
Your money back.
I have a question.
Yes.
On a negative bond, if you were to invest in a negative bond, where does the money go? It just evaporates.
It gets spent.
It's just evaporates. You lend at 100 and you get back 99.
What they essentially do is they invest in assets that don't produce as good of a return. So, or doesn't produce. They lose money on an asset, so they pay you back what they have left. That's what it is.
That money goes into the past, right? To pay off bills in the past.
Yeah, it goes into some charlatan's hands that the Japanese invest in. Look, here's the negative yields thing. Part of the reason I took a Mike Arnold and said I have nothing to say about that. Japanese government bonds are they've been a terrible investment for coming up on 23 years now. But a huge segment of Japanese culture is forced to invest in Japanese government bonds by law. So they can almost have a negative 50%, and I don't know if that's going to change. There's a huge segment, Kyle Bass being one of them. There's a lot of hedge fund guys out there that are now trying to bet on the collapse of the Japanese government bonds. But again, they can print to pay their bills, and that will be a decreasing currency, but they'll just print more of it. So it's like a dog chasing its tail. Eventually, it's going to catch it, but they can go in circles for so long that I just think it's you should short the yen, not short the JGBs.
Wait, I actually have a comment here. I don't know where I heard this, but people borrow Japanese yens to then use that as purchasing power in the markets, right? And that is what was risk on from before. Does that make sense?
There have been people, Kyle Bass being one of them, that Kyle Bass purchased his house in yen. That was a big thing when he did it. He purchased his house in yen. He went and got a loan in yen and then converted them to dollars to purchase his house, and he pays his loan back in yen. Right. Because he essentially is getting money. Well, now he is. Now that when the dollar was strengthening against the yen, he was having lower and lower payments. But now the dollar is weakening against the yen, which is hysterical to me because, again, they have negative yields, right? So when you put your money there as a safe haven, which is what's been happening since the Brexit, and for quite a while, actually, you look at a monthly dollar yen chart, essentially the dollar has been weakening against the yen since June, right? Since June of 2015. Since June. I mean, it's only July 1st, but since June of 2015. So the dollar's been weakening against the yen for a year.
Very interesting. Back to Kyle Bass real quick. One of my favorite trades of his was back. I mean, he still has it, of course, but back in 2011, he bought and he took delivery of $1 million worth of nickels, which is 20 million coins. Okay, because their 6.8 cents value as scrap metal exceeds their monetary worth. So he actually bought up $1 million of nickels, and the scrap value of the nickels is worth more than the face value of the coins, but he took delivery of 20 million nickels.
Oh my God.
I love that.
Where did he get them?
I have no
idea. Like, who did he call? I called my nickel guy.
I called my nickel guy, and I mean, that was just priceless. So speaking of all that money in nickels, now there is, here's an interesting stat, 11.7 trillion in negative yielding debt in the globe.
Hello.
What?
No, sorry. I got a call again. I forgot to put this thing on Do Not Disturb again. So I lost
you messed up my $11.7 trillion in negative yielding debt worldwide, and that's up 1.3 trillion just over the last 4 weeks. Just think of those numbers. Yeah. 11.7 trillion in negative yielding debt now. That's a lot of money.
Yeah, I'd like to see a breakdown of that because it's a lot of money. But so Bill Gross has talked about this, right? He actually wrote an article about it 2 weeks ago, calling it a default or a debt supernova that was getting ready to explode, something like that.
Show title.
Yeah, debt supernova, he called it, I think. We talked about it a couple of weeks ago, and he said that 11.7, he used that exact same number, that 11.7. I want to see a breakdown of this. Like, where did all this negative yielding debt come from? Who bought it? Is it all Japan?
I don't have the breakdown in front of me, but I'm sure you could Google it.
Well, what I'd like to know, what percentage is that of total global debt? I don't know. I mean, maybe we can look at that for next show or something.
Yeah, maybe you'll have to do some research.
Yeah, I don't know. I just, again, it's one of those things. It's like we have this podcast to be able to talk about our own opinions on this stuff. But, our jobs are to figure out which way things are going. And to watch stocks go up in this environment it's hard to trade the way that we trade. We still do, but it's hard. Like, how do you when you get a buy signal in the S&P, how do you buy it knowing all this stuff?
I know, but again, things can remain irrational. Things are going to do it. That's why we can only wait and watch for our setups and then take the trades that set up instead of trying to predict. Because, long term, I think what we've talked about, it's all going to end in tears. But I don't know when that's going to happen. I know something else that's not very good, though. Puerto Rico now they're going to default on about $2 billion in debt payments as of today. They just came out today, Friday, and that includes $780 million in constitutionally backed general obligation bonds. Their governor, Garcia Padilla, also declared states of emergency this is my favorite, at the island's biggest public pension. I don't know if you've heard this stat that came out today, which is the Commonwealth's employee retirement system. It's more than 99% underfunded.
Why don't they just say 100?
How do you underfund something? That essentially means it's not funded.
They're sending out really small checks still to everyone.
We've managed to underfund it 99%. Who even was attempting to fund it then? That was my question.
I mean, it's... I swear, this is actually Puerto Rico. The whole Puerto Rico thing's a pet peeve of mine. I think the U.S. treats it like such an unloved stepchild. It's unbelievable. because the U.S. used to back Puerto Rico's debt. And I think it was maybe in 2011, but don't quote me on the date. There was the laws or the regulations that caused the U.S. to back Puerto Rico's debt expired, and Congress just let them expire. And so this is not the first time they're defaulting. This is the biggest one, obviously. And now the Congress is expected to issue laws that says you can't sue Puerto Rico for defaulting on their debt. But like they're a commonwealth. It's like they vote, but the vote doesn't count. Give them statehood or let them go. This is so stupid. Why do we do this? Like, we're going to now pay Puerto Rico's debt. It's going to happen, right? It is. We can't let them. I mean, it's going to be an entire island. What are we going to do? We're just going to let them default. They're going to let them go to crap. They're going to have crime. They're going to have an internal. And then they're just going to vote themselves out of the U.S. What are we going to do? Send an army over there to keep a defaulted state?
They're going to Brexit.
They're in an economic tailspin. You know, they're in an absolute economic tailspin.
Well, you're figuring out if you need a passport to get to Puerto Rico. I just want to comment. Our Fed heads are talking again because it keeps scrolling by on the Twitter. So
the Twitter.
The Fisher just said Brexit could have effects on the U.S. economy, and Bullard just said sees little impact of Brexit on the U.S. economy. I just think that's funny. Two back-to-back little bits there.
I've got nothing to say about that.
Until you follow up with the next thing. Speaking of common poured, UBS credit recession model just went up to 34%, highest since last recession. So their model's creeping higher and higher.
I want to find the guy that I was on TV with, a guy who said the Fed can't do a one-and-done rate hike.
Well, they are one and done.
And I came back and said, why not? Why can't they do a one-and-done rate hike? If we go into a recession and they cut, that's officially a one-and-done, isn't it?
Yep. Oh, Standard & Poor's just came out with this quote, all told, we expect the repercussions from Brexit to weigh somewhat on U.S. GDP. That was the S&P's U.S. chief economist. Combining this with lower than expected first quarter growth leads to lowering of our forecast for growth this year and next. I think everything's going to get blamed on Brexit. Period. Whether it has any impact, everything's just going to be, well, it's slowed down because of Brexit. Everything's going to, that's like, remember when we went through that period of time where everything was blamed on the weather?
Yeah.
Now everything's going to be blamed on Brexit.
That's awesome.
So that's going to be the next, you watch. If we slow down at all, if we have any bumps in the road, it's Brexit's fault. It's always going to be there. That's going to be the new whipping boy for the next however long.
Britain always wants to, like, look at me. So they're getting it.
There's things I want to happen that I shouldn't want to happen. His name's Michael Prento. I found him. I found you, Michael. Michael Pento, sorry. Michael Pento, let's see who Michael Pento is, because I don't know who he is. I'm sure he doesn't know who I am either. President of the Pento Portfolio Strategies.
What does this have to do with anything?
Michael Pento wrote an article, Fed One and Done is a Wall Street Fantasy.
Ah, there we go.
I got nothing against Michael. I don't know Michael. I was on TV with him when he said it, and then I'm not sure if he was the one who said it on TV, but he wrote an article on CNBC. I was on with a guy who said the Fed can't do one and done, and I said they absolutely can do one and done. Why can't they? Because they never have before. So there's a teaching moment for us, Michael. I'm speaking to Michael Arnold, not Michael Pento.
Yeah, you're confusing. There's too many Michaels. Anytime
you say it can't happen, it usually happens right in your face.
That's
your face.
That's like when you say in life, I'm never going to fill in the blank. That's not a good statement to make.
Yeah, you should never say they can't do it or this can't happen. Now, by the same token, we every once in a while like to say I'm buying this and I'm selling that. And then a lot of the times you'll hear us follow that up with a disclaimer. It might not happen, but that's what I want to do. That's because we're so cognizant of this I can't happen or it will happen scenario in markets. You can't do that.
Is that the scientific law, Murphy's Law?
Yeah. What is Murphy's Law exactly? Does anyone know?
I think That's an interesting. That's something that I can look up.
There you go.
Speaking of one and done.
I'm sorry, one last thing. In the same article, he said, nevertheless, for the first time in history, the Fed will be hiking rates into falling inflation, negative earnings, and revenue growth on S&P 500 companies, and falling global domestic product growth.
So Murphy's Law is an adage or epigram
We're smart in this show.
that is typically stated as anything that can go wrong will go wrong.
Wow. Who was Murphy?
Well, I don't know, but
From RoboCop, he was Officer Murphy.
I doubt that was
Breaking news, Mike.
breaking. What's breaking?
Breaking news. 1 minute ago, Fed's Mester sees danger in waiting too long to hike rates.
They're all over the place again. What do these people in the market will probably rally off that too? It'll just rally right now.
Cleveland Fed President Loretta Mester believes the central bank was right to delay raising rates before the Brexit vote, but shouldn't wait too long. It was clear that there was going to be volatility in financial markets surrounding the vote, Mester said in prepared remarks for a speech Friday at the European Economics and Financial Centre in London. If the vote favored exit, there was a potential for disruption in the market. Given that, I do not think U.S. monetary policy is behind the curve yet. I saw little cost in waiting to take the next step. However, if we fail to gracefully navigate back toward a more normal policy stance at the appropriate time, then I believe there is a non-negligible chance, a non-negligible chance that these tools will essentially be off the table because the public will have deemed them as ultimately ineffective.
Non-negligible.
It's a double negligible.
Yeah.
Live.
Hypercharged. It's a supercharged double negative.
So what are they saying now? So you bunch these, they're all over the place then.
They're all over the place again. This is 2 today.
Well,
Fisher. Was it Fisher? That I talked about earlier?
Had Fisher, Bullard, and Mester all speaking.
Mm-hmm.
So, oh boy. All over the place. I don't even know what to make of anything. And we're back at 2,100. And the Dow just topped 18,000 and pretty much erased all the Brexit losses. But bond yields are still going to record lows.
Yeah.
Speaking of all that, just on a funny side note, you can relate to this, Bob, not exactly the same, but did you hear this week about the California woman who successfully sued Microsoft after Windows 10 auto-installed in her computer without her permission and rendered the machine unusable?
I did hear about that. And I thought, why couldn't I get in on that? My machine is usable. I am the resident, I know nothing about computers, and I blame my computer when I do something wrong guy on the show. I'll call Mike all the time and be like, Mike, my computer did something again. And Mike will be like, did you touch any keys? Well, yeah. Well, then
did you click on that?
I disagree. You're the only one who goes in the field, has the courage to go into the wilderness and be on the show and call in. Mike and I would have no courage to do that. We need the comfort of our screens.
No, I updated the frickin' computer to Windows 10, and I hate it. I absolutely hate it. I'm so mad that I did it still. I can't find stuff that I know is there. Michael, send me something. I'll download it. I'll copy and paste the title and put it in the search, and it tells me it's not there. And I still struggle with this thing. And that woman won $10,000. That would allow me to purchase a computer with old Windows on it. I don't know.
Or a Mac that will dual boot.
What do you guys like? You like VMware or Parallels? Or,
well,
I use Parallels and VMware. It depends because
it's great.
I keep them running both because the one will update and then it'll sort of screw stuff up. So I'll switch to the other one and then they'll update that and screw it up. So then I'll switch back after they fix the first update. So I keep them both around.
I'm getting scared because oftentimes, like my mom, I see my mom and myself as computers get faster and better and faster and better. And I still just haven't overcome, how to open things. And it's like, I see myself becoming my mother. She'll she'll get a text from me and she'll go, look what your sister sent me. And I'm like, that's from me, Mom. Look, my name's at the top. Oh, it was just the same color as the other one. And I'm like, oh my God, that's me already. It's already me.
It's already you.
Oh, I hate it so much.
Well, here's a phenomenon that links up to that. VR is right now in gaming's very hot. Getting these GPUs faster is very hot. I mean, these are hot sectors in American technology, and VR now, which is headset and headphones and optical trackers in your room, are now you can basically buy a commercial version of that, and there are games and all that stuff. And people our age, right? In our middle age, right? When we put on this technology, or people older than us, we freak out. But you give it to a child or a teenager, and they're like, "Yeah, whatever."
I still get motion sickness playing Doom.
I play all games on my phone. Does any of that apply, Stafford?
Nerd.
I play all games on my phone. I don't play anywhere else. I don't feel a need to buy any sort of gaming system because I'm not that into it. But I mean, there's certain games I'm just absolutely addicted to.
Oh, yeah, there are a couple casuals. I do the SimCity. I've been doing that for 2 years. It's budgeting and making things. And that is very interesting because you have these mobile games and console games and then PC games. And all these sectors and markets are all colliding. Xbox, Sony, Nintendo's going to get back in the fray.
I've never played a PC game in my life, not even once. I had consoles, obviously. Everybody did, right? But I'm really into mobile gaming because my phone is always with me, and there's times where I'm bored. And I don't like to read things on my phone because my mom's eyes are becoming my eyes as well. So the little type, I refuse to upgrade my phone and do the big type. Not upgrade it, but go into the settings.
Do the 125%
I refuse to do that. So like a story will pop up in my phone. I'm like, yeah, I'll print that out later. And I'll just play a game. But now, like, I downloaded this Rocky boxing game, and it'll describe the fighter that I'm boxing against, and I can't read the description.
Oh, no.
That's why you keep losing, because you can't figure out who you're fighting. So you're I don't know what strategy to use. I'll just hit him.
I'm like the light heavyweight champ of the world right now, but I can't see the guys, like where it'll say he's from, you're fighting a guy from China who came up through the slums, and I'll read it as I'm fighting a guy from, Croatia who came up, making sums of money. I just can't read it at all. It's awful.
All right, let's see if you can figure out this segue. Speaking of China, Nike reported earnings this week.
Don't know what you're talking about.
Where does Nike make their shoes?
They make a lot of them in China.
There we go. See? You got it. Look at that. That was an amazing segue.
Yeah, that was actually really good.
See?
So I agree with the Motley Fool. The Motley Fool says there's an athletic apparel bubble. And I think I agree with them because the pendulum swings, right? And it's so they both Nike, Under Armour, and then obviously Lululemon, who created the niche of athleisure, right? Athleisure is a niche. Lululemon basically created it for women. They now have a competition from a company called Athletica and another company who's actually owned by Kate Hudson, or she's part of the company. I don't think she owns it, but I don't know what the name of the company is. Nike, Adidas, Under Armour, Lululemon, Athletica, all essentially are making tons of money from this athleisure thing, right? Where your athletic apparel is proper apparel for wherever you go, whether it's a grocery store or dinner or whatever. I was having dinner with a friend the other day at a restaurant, and he had an Under Armour shirt on.
You can look like you can look like you're a member of Star Trek anywhere.
Yeah, with the logos and stuff. Yeah. Anyway, I think it's a bubble. I think athleisure is a bubble. I don't know if it's a permanent trend change. I think the pendulum's going to swing, and people are going to start getting tired of seeing other people in their sweats, and they're going to start wearing regular clothes out again. But I could be wrong.
Yeah, well,
but
anyway, see that everywhere now. Everywhere I go, it's like everybody looks like they just got out of the gym.
Yeah, it's just a completely comfortable, common thing. And like my nieces, who I always look for future trends in them, That's why I still want to own Apple, because my nieces only know Apple. They don't know anything else. They don't know PC. They don't know Android. They just Apple, Mac. That's it. That's all they do. But they also, they only want college athletic wear. That's all they want. They don't want regular clothes. And they go out with their friends, and they're just in college athletic wear or shorts if it's warm out. That's all they do. That's all they wear. They wear yoga pants. My middle niece wears track pants. That's it. That's all they do. And it's completely fine, and it's what they expect to wear and what they expect to see their friends in.
That is interesting, because
that argues it for not being a bubble, right?
When the millennials pick up the Hillary moo-moo, look out.
No, I'm not going to, because that's political.
All right.
Well, what do you think about this earnings? I mean, can they recover from this, Mike? What's the stock done?
All right. First of all, they are a master financial engineering firm.
When Mike stutters like that, he's got a lot to say, just so you guys know.
Nike's been, between their buybacks and all their other they're one of these brilliant financial engineering firms that they will attempt to beat their numbers no matter what, by hook or crook. I mean, it's technically legal financial engineering, but they are pushing the boundaries to the extreme. But they again beat earnings. I think it was expected 48. They came in at 49, and they again share buybacks and everything else. Let's see, revenue and future orders fell, which is really interesting because this should be a really good time for them. And we'll have to see if this turns around at all next time when they come out with their numbers, because you have the Europe soccer stuff going on right now, or football, sorry. You have the Olympics coming up, if they'll actually, between Brazil probably collapsing and Zika, which I think is totally overblown, but that's a whole nother story. Nike's actually not doing that hot in terms of their underlying numbers and where things are headed. What's interesting is they came out with these numbers. They fell down to a low they were down like 7% after hours. And they went down to 49.15. And then by the next morning, they were up actually 2% from the previous close. And now they're much higher than even that. They've essentially gone, now they're trading 55.61. So people just said, whatever, let's just buy it.
What's funny is they didn't get a LeBron bump like Under Armour got a Steph Curry bump.
Okay,
when LeBron James won, right. Okay, so everybody knows Cleveland won the. By the way, we need to talk a tiny bit about that, but Cleveland won the NBA title. Nike did not get a bump. The stock didn't. Just stock got a brief bump, but Under Armour got a massive bump when Steph Curry signed and won it. And it kind of just shows you that Nike is considered old. They're considered older.
Yeah,
they got the older stars.
Mature.
They're not. It's not hip.
Yeah.
And actually, like the LeBron shoes are hideous.
Well, what's
the
funny
Steph Curry
is
shoes are much cooler looking.
Adidas is starting to kick Nike's butt in certain segments.
Yeah.
So,
see, Adidas gets a lot of a big overseas bump.
Yeah.
They do a lot of the soccer.
Yeah. Football.
Yeah.
Well, and how's the strengthening dollar going to affect Nike?
Well, shouldn't help.
Yep. So we're good. I
it's
think
not going to help.
I think actually, this is not a recommendation, of course, but I think Nike's on this rally is a pretty decent short.
Yeah.
I will not be surprised to see this below 50. Again, don't have timing, but this is not a company I would be buying.
Take a look at a daily on Under Armour, Mike, because it just broke out of a horizontal channel and just popped above its 50 in the last 4 days. And I think a pullback to the top of that horizontal channel on the daily is probably a good buy in Under Armour. And again, they are just robbing Nike. Under Armour and Adidas are just taking Nike sales. And if I'm wrong, that athleisure is a bubble and it is actually here to stay, which again, looking at my nieces kind of argues that it is here to stay. Under Armour is a good medium-term stock, I think.
Well, Under Armour, yeah, I could definitely see us on a pullback somewhere to, 39.50 to 40 level. It could be a decent purchase in that area. We still have an unfilled gap. We have the 200 moving averages is about 41.50. Break through that, we have an unfilled gap about 42.20 to 42.50. So after possibly a slight pullback, I could see this making a run to about the 42.50 level.
And it wouldn't be a bad trade.
Right, that would be a very interesting trade. So that was a good call there, Bob.
Bob, I have a question. Did I hear correctly? You want fair and balanced, so we have a shout out segment called Sports Corner. And we can bring up Buddy Ryan passed away.
Well,
I just great Chicago Bears Super Bowl.
I want to talk about correlating markets because I'm a Chicago Cubs fan, and this year we had, I think it was Leicester win the Premier League, which is unheard of.
I actually know that one.
Unheard of, right? And we have Iceland eliminating England.
That was actually a bigger shock than Brexit.
Yeah, right?
Think about this. How big's Iceland, okay?
By the way, there's this.
Or is that Greenland?
Iceland's green and Greenland's ice.
Yeah, that's the one thing I remember. But there's a YouTube couple that do these YouTube things. They're from the UK. They do these YouTube jokes, and the girl is supposed to be an airhead, and the guy asks her stupid questions. Like he asked her last week if she bought a medium pizza, and the guy said, "Would you like to cut it into 8 slices or 12? Which would you rather have?" And she said 8 because I can't eat 12 slices. And it's this whole thing, and he keeps trying to explain to her how it's the same pizza. But anyway, there's one where he asks her about the Brexit vote, and she says, "I can predict that England is going to be out of the Euro in football as well because of the Brexit vote."
Huh.
So
see, the Brexit's going to get blamed for everything. It's the Brexit was actually England lost in football because of the Brexit,
and it's the Euro Cup.
Yep, and it's the Euro Cup. And Iceland. Now, the population of Iceland is 332,000 people, which essentially means everybody who tries out for the Iceland soccer team is going to make it because there can't be that many great soccer players in Iceland. So you had everybody who tried out made it, and they just kicked England's butt.
Well, anyway, Iceland beat England, which was probably a bigger deal than Leicester winning. Yeah, which was probably a bigger deal than Leicester winning the Premier League, the Premiership, right? I want to make. I don't know if I'm saying that. I think it's Leicester City. Yeah,
it is Leicester City.
They won the Premiership, which is a huge deal, right? Huge deal. And so I think this correlated markets. Cubs win the World Series. I don't know.
Well, we'll see.
Correlated markets.
We'll see.
Cubs win the World Series.
It's correlated markets.
Again.
That is the same voice everyone
when
said.
I see it.
That is the same. That's the same voice everyone said.
The Billy
Iceland beats England.
The Billy Goat Tavern curse is withdrawn, so the Cubs really can win the World Series.
He's withdrawn it every year. I'm just saying, Leicester wins the Premiership, right? I mean, Iceland beats England.
Well, hey, Cleveland finally. How long this is their first championship, right?
Oh, Cleveland won. That was the other thing.
You're right. You're going back. Sports Corner.
It is the city of Cleveland's first championship in like 58 years. Something. The entire city.
So
every sport. And they have a football team. They have a basketball team. They have more than one baseball team. I mean, Cleveland Indians, Cincinnati Reds, I guess.
That's Ohio.
Yeah, I know. That's Ohio. But Cleveland Indians, I think Cleveland Indians were the last winner, actually. But Cavaliers, I don't know if the Cavaliers have ever won one. I think
this is their first championship. You're supposed to be Mr. Sports because we're the nerds. You're the Mr. Cool Jock guy.
I don't want to do that. But yeah, so that's the Chicago Cub thing. So again, things that can never happen.
All right, and that's Sports Corner.
It's a theme.
See, we've avoided sports talk for a number of weeks, so we got it all compressed into this one little segment.
Yeah, Sports Corner. Yeah.
Speaking of sports, let's get to the what and the why.
Today's edition of The What and the Why is brought to you by Motive Wave Software. Motive Wave Software is a well-established developer of easy-to-use, full-featured charting, analysis, and trading software built for the individual trader. Motive Wave offers the best charting tools used by the pros, such as Elliott Wave, Fibonacci, Gartley, Gannon ratio analysis, but it's presented in a very easy-to-use way. Motive Wave has a product to fit any budget and any trading style. And one of the very best features, it's available on Windows and Mac. So go to pathtradingpartners.com right now to get your 14-day free trial, and then visit them at motivewave.com.
My why of the week goes to a little bit of what I was talking about. I made fun of Kenny Polcari today, and I made fun of Michael Pinto. This particular guy, I'm not going to say his name because there's a lot of people that say what he said this past week, and it drives me crazy when I hear it. And this guy was basically very negative on gold as an investment. And his reasons were, which this is the part that I hear over and over again from people, including Warren Buffett. But this is Warren Buffett's personal reason. He doesn't necessarily put it out there as investment advice. This guy said, I hate gold as an investment because gold doesn't produce anything. It doesn't pay a dividend. As a matter of fact, you have to pay to store it. Let's ask Kyle Bass if he has to pay to store his nickels.
It's
you have to pay
house.
to store it, right? And you have to insure it. And therefore, gold is just a terrible investment in general. And it drives me crazy because this particular guy that said it this week, the reason it bothered me coming out of his mouth is because I know him from the trading floors of Chicago, the commodity trading floors, where every single thing, every hard commodity that we trade doesn't produce anything. Hard commodities are an ingredient to something else, right? Corn in and of itself doesn't produce anything. Corn is produced, and it's an ingredient to something. It's an ingredient in food. One of the comments this particular guy made was that you can't eat gold if you're hungry. You can't live in it if you don't have shelter, all right? Yeah, you can't live in lumber either. Lumber can be made into a house. Commodities are an ingredient to something that people want. Right? The value of commodities comes from the desire of people to have it. Yes, you can eat corn, but you don't have to eat corn. You can eat cattle. You can eat peaches. Right?
Peaches,
I mean, you can eat anything. Okay. So what I'm saying is the idea that a commodity, if you're saying gold is a bad investment because it doesn't produce anything, then you have to say that about every hard commodity that there is. And I just think that's ridiculous. If I buy gold at $1,500 and I sell it at $3,000, you know what gold has produced? A 100% return for my portfolio. That's what it's produced. Gold has a value to people, therefore it has a value. Gold becomes jewelry and it can be currency. You can't go somewhere and pay for something with gold. Yeah, right now I actually can. I can go to Wabash Avenue in Chicago and I could turn in a gold bar for money that I can then spend at the jewelry store right next door or the bar right across the street. And it's a ridiculous statement to say that gold is a bad investment because you have to pay to store it. You have to pay to build on a piece of property that you live in, and you have to pay interest on the mortgage that most people need to buy real estate.
Property taxes.
And you have to pay property taxes. It's the argument drives me crazy, and that's my why. If you think gold is going up, it's just as good of an investment as something else that's going up, like a stock. If you buy a stock that doesn't pay a dividend, it's essentially the same as gold. The company that produces the stock produces a product of which you can then gauge. But the stock is an ingredient in that production because they sell the stock to make money that they then put into their business to produce the product. I'm sorry, that drives me crazy, and I hate when a professional says it, especially a professional that comes from the commodity complex.
You know what I hate?
What?
When the market ruins my what segment.
Did it already ruin it?
Well, my what, speaking of precious metals, was platinum's double bottom on a daily chart, which was triggered yesterday on the closing price of $128.40. So, and earlier today, it was still trading around that level, which was a valid entry area still. Well, our target for that was between the 172.30. We have a minimum target and a maximum target. Minimum target would have been around 172.30. Maximum target 1088.90 or essentially 1089. When we trade these double bottoms, we move our stop and it's no longer a valid entry once it hits a certain price projection, which is the 50% extension, which was trading at 1055.60. Guess where platinum's trading right now, Bob?
Where?
1055.90.
Wow.
We're already moving our stop. So this is like the market's already, everybody's going to say, yeah, you go, look, great call. It already got to where you move your stop. It's sort of a guaranteed one there, buddy. That's what I'm going to hear. I'm going to get the emails. A great call. After people listen to this support, we couldn't do anything with that information because the market ruined it.
Well, let me add to your what. You know what Mike's what is? A double bottoms, especially in the way we teach and trade them at Path Trading Partners, are a high probability trade. There's the what.
Well, there you go. You converted it. You spun it. The market hates me, Bob.
And you won the championship.
You won it. Definitely got one.
One.
I think that's a good what. I think it's a spectacular what, quite frankly. And I think it, again, goes to the fact that, we put on trades regardless of what we think. Platinum doesn't produce anything. And you got to pay to store it.
Really?
I guess. I don't know. That just drives me crazy.
Well, I wish I
could say the guy's name, but when I see him next, I'm going to tell him.
I have breaking news.
What do you got?
The New York Fed second quarter nowcast. I love that. It's a nowcast. Nowcast GDP forecast comes in at 2.1% versus previous of 2.1%.
That's just so breaking.
Yes. Well, now you have the Atlanta Fed that always does their GDP projections, which is at 2.7. The New York Fed actually came out with they started releasing their model just a few weeks ago. I guess they're competing. I guess they have a inner office rivalry, like Fed offices. Fed regions are now having who can predict it better. So New York Fed's at 2.1, Atlanta Fed's at 2.7. You think they take bets on it?
We're not supposed to say the word bet.
Why not?
I don't know.
Can we never say the word bet?
I think that's a silly thing, too, because you place bets in the market, and there's a lot of entities out there that consider that to be a negative thing when you call them bets. But we do place bets in the market, and we're the casino. We're not the player. We have the probabilities in our favor when we trade, as opposed to the other way around.
I don't think we can say bookie.
We said bookie during the pre-Brexit podcast.
Yeah, we can do that. Yeah.
I can say, don't hate the player, hate the game.
You know what else I can say? You want to hear what else I can say?
Sure.
I'm
really.
Bob Icino. I'm Bob Icino, and I'm done talking to you guys today.
Well, I don't have much to say about that.
As usual.